welcome to the second webinar of the Path to Professional Trading course. So today we chose to talk about fundamental analysis, which was one of the key analysis schools in assessing your trading decision in forex trading, especially. So if we want to have a clear look on what is fundamental analysis, so it's just assessing all the news analysis, all the news information, the economic indicators, financial indicators that come out. But mainly for stocks, it's more into assessing the balance sheets, income statements, and other indicators that give us more information about the money flow for the company, or about the company's future plans, about the board of directors. So all these data will come in play if we are doing fundamental analysis for stocks. But when it comes to forex trading, there are much more factors that we have to look about. So we are assessing in general the wellness or the strength of a certain country, and this will definitely have an impact on the currency, on its currency. So first, we're going to start by talking about by giving a brief about the economic calendar. What's in the economic calendar? We're going to explain the economic calendar, and then we're going to go and talk about each economic indicator. We have set of economic indicators that usually investors monitor to take their decisions in forex trading. So this is going to be a good part, and then my colleague Sai will talk about the role of central banks, and we conclude this webinar by talking about the top market movers that they are currently impacting the market. So I can see some hands up before starting. So if anyone has any questions, so please, if you just can write your question before starting. If not, we can continue. Okay, perfect. So the fundamental analysis it's a method of assessing the market by analyzing economic, social, and political factors. So we have a variety of factors. The economic factors, there are mainly indicator or economic releases, economic events that they can impact a trader's decision or even the market. So these we can find them on the economic calendar. The social factors depends on a variety of stuff. So this will have to come play the trader himself. So he has to assess these factors, and the political factors. We all know the factors that mainly affect a certain currency, since mainly they are the worst of these factors are security factors. So as I mentioned, if the overall state of the economy of a country is strong, then this means that its currency could strengthen. It's safe, so people would definitely go for safer countries to invest in their currencies and even in their stock markets. But would definitely not consider investing in a country that has certain problems, or it's not safe in general. So this will come and play definitely when you take a decision on which currency you want to invest, or which also stock market you want to invest in. So analysts, they believe, while talking about fundamental analysis, analysts do believe, or investors who are following fundamental analysis, they do believe that the price of a certain currency may be incorrect on the short run. So the market is mispricing a certain financial asset, and on the long run, the price will definitely correct itself. So for example, let's take into consideration. So you believe like a certain country is not performing well, so its economy is not performing well, and still its currency value is still a bit high. So definitely you have to look for this opportunity, since you will believe that if on the long run this currency, there will be certain correction in price where the price would translate the state of the economy or the state of the country. So this is the main idea behind fundamental analysis, or the pricing of or the pricing of certain assets when you are taking into consideration fundamental analysis. Traders do buy or sell the wrongly priced asset and wait for the market to reprice the security based on several factors, as I just mentioned. So we have different categories of economic indicators. We start with inflation, economic activity, employment, confidence, and central banks. So these are the key categories, or big categories, that we take into consideration when doing fundamental analysis. Under these categories, they come certain economic indicators we can find these indicators on the economic calendar. So each website has an economic calendar, or each website that is related to forex trading do have a certain calendar. On this calendar, we will be able to set the time based on our current time, or you can go for GMT, for example. You choose your current time. You can do also filters to filter out the news that you don't want, or the news that you believe they are most important to you. So you can decide on the countries that you want to follow their economic releases. So you go, for example, for the United Kingdom, Eurozone, United States. So it depends on which currencies you want to trade. So this should be in your you filter your results based on this. On the calendar, you can see on the left there's the time, so it's the time of the release. It will be exactly the event, or the economic release will be exactly sharp on time. The second column is the currency, so the currency that's affected or mostly impacted by this economic release or this economic event. So here, for example, GBP, the Great Britain pound, Euro, United States dollar. So you can see the currency, the importance. Here we have stars. Other websites, they go for bulls or stuff. So for example, this would range if a certain economic indicator is not as much as important. So I go, for example, as an importance for 1 star. So this means that it could have minimal impact on the market. While an economic release or an economic event with 3 stars, it means that it could have a huge or significant impact on the market. So usually traders would definitely have to look for these economic indicators with high volatility or high importance, since they will affect the market at most of the times. Also, then we go for event. Under event, you can see the economic indicator. For example, here we have the GDP. We're going to talk about the GDP in a while. ADP, non-farm employment change, and you can see here 3 columns: actual, forecast, and previous. So we have a previous reading. It was the reading that was published last time. So some of the indicators, for example, they are published monthly. Some of them, they are published weekly. For example, the initial jobless claims in the United States, it is published weekly. We have also crude oil inventories. It is published weekly. There are some other indicators that they are out twice in the month. We have the preliminary reading and the final reading, and there are some indicators that go out quarterly. So this is the previous reading. It depends on the previous release. We have a forecast also. The forecast is the consensus or the market, the analyst's forecast on what this reading could be, where it could stand, and the actual reading is the reading that is released on the day. So for some indicators, if the current actual reading is higher than forecast, it means it's good for the currency. So we can see that the color of the actual numbers would be in green. If they are worse than expected or they aren't good for the currency, they could appear in red. So this is all you need to know about the economic calendar. We have also one more thing for economic indicators. If you want to, if sometimes you look for an economic indicator and you can see here, for example, MOM, month over month or month on month, and you can see quarter on quarter, year on year. This is the difference. So here we're calculating the difference, pending home sales, the difference month on month. So this is the difference between, or the change from between August and July. This is the change between the first quarter and the second quarter. This is the change between last year and this year. So this is also something that you have to watch out for. So now let's move to talk about the top economic indicators. So we started with inflation. Inflation is one of the key things that central banks do look for. So inflation, we have a couple of indicators that do guide us about inflation. So we start with the consumer price index, which gives us an idea on how much a consumer is pricing, or a consumer is paying for certain goods. So this change in price of these certain goods and services, that will be released as consumer price index. Usually central banks, they do set an inflation or CPI level, for example, between 2 and 3%. They consider it a healthy level. Above 3% is considered hyperinflation, and below 1%, usually they consider it as low inflation, or sometimes as deflation. So this is what you have to watch out for in terms of inflation. Consumer price index is one of the key indicators to watch out for, especially with the coming days, since we're hearing a lot about negative inflation or deflation, especially in the Eurozone region, in the Euro region. So we're seeing some negative inflation prints. This could definitely impact the decision of the central bank on the long run. Also, we have the producer price index. So this is also the change in prices that the producers are paying for certain goods or services, and definitely when producer prices goes up, when the producers' prices go up, they will definitely impact the consumer prices. So if a producer he was charged additional value for a certain element, he will also increase the price of this the manufactured product, and then the consumer will have to pay a higher price for the product. Also, we have the personal consumption expenditure. It has good importance for the Federal Reserve. It's one of the main gauges that the Fed do look out for in terms of assessing inflation. Commodity price index, it's prices of commodities, the change in prices in commodities. So this also comes into play when we're talking about currencies that rely on commodities. Services price index for countries that do run mainly on services. So this is also important to watch out for. Imports price index, this would affect countries that do import a lot. So if they are paying cheaper or the prices of their imports are decreasing, so this means that they are paying a less amount for the goods that they were importing, and this could be beneficial for the economy. House price index, this gives us a hint on the performance of the housing prices. So after 2008, this was interesting for most of investors, especially for the first couple of years after the financial collapse in 2008. Investors were monitoring the house price index for a certain alert on any collapse. So this is about inflation. Now we move to the economic activity. Economic activity, you have many indicators also under it, since you know that the economic cycle is just dependent. So, for example, if we have if the economic activity slows down, this could lead to, for example, let's take it into consideration. It's very on a very basic level. If I want to go out today to the shop, if I was able to go to the shop, I'm gonna go to the shop and buy a certain product. So the shop will benefit. The employee at the shop will also be safe. That he will continue to have a job and not be fired at a certain time due to drop in the sales activity, and also the factory that is producing the goods that are being sold in this shop also will be delivering, and they will be looking for they will be having good sales, and this also will secure the jobs of the people working in factories. And if this performance is just going on and on and on, and it gets better, so also companies will start looking, for example, for certain additional wages or raises or bonuses. So when you earn, for example, a bonus or raise, you can also pay for another stuff, or you can invest in certain stuff. So definitely this economic cycle, it's all dependent on each other. So one drop in the cycle could affect the total economic activity. So for example, let's take it into the other direction. If today I was fired from my job, I wasn't able to afford to buy, for example, clothing. So I go to the company, the shop that do sell certain, for example, clothes or stuff. They will also have less sales, and when they have less sales, they will also go for cutting cost. And when they cut cost, they will consider laying off some employees. And also when they don't have enough sales, they won't ask for more factory orders. So also when these factory orders are less, also the factory will go for certain measures, and after that, this will affect definitely the banks, and will affect the credits. We will have also a higher bad debts. So this is all a cycle, and it all follows each other. So then let's go back to the economic activity indicators. We start with the GDP, the gross domestic products. It's everything related to the economy. So everything that that has a certain value in the economy is just included in the GDP, and especially people do watch out for the last part of the GDP equation, which is imports minus exports. So moving to retail sales, it's how many sales we're having in stores, and definitely higher retail sales would be supportive to the economy, and maybe also supportive for stocks. For example, this could mean that we're in a healthy economy and the economic activity is much better, or in good health, and this will lead also people or investors to invest more in stocks, since this could mean also that companies are performing well. Durable goods orders, they are the goods that we don't change every day. So mainly this type of indicator, we look at it when we are at the end of a certain economic expansion. So when people start changing their durable goods more often, this means that they are more capable of spending money. Industrial production, everything related to production and to production itself, and also the industrial work. So this is also a positive reading, is good for the economy. Purchasing managers index, we have different readings for the purchasing managers index. We can have a certain calculation for the services sector, manufacturing sector, and construction sector. We have a 50 line. Above the 50 line is usually signaling that we're in expansion mode, and when it drops below 50, this means that we are in a contraction mode. And we've seen following the COVID-19 outbreak, we saw the economic indicators, especially the purchasing managers index, were dropping sharply as the economic activity was dropping. And when we gained back track, and the economy gained back track, and the economic activity was back on, we saw also PMIs recovering to above 50 levels. The trade balance is just imports minus imports, exports minus imports. So as long as you export more, you have a positive trade balance. As long as when you import more, you have a negative trade balance. So this could lead to trade surplus or trade deficit, and this will definitely affect the GDP reading. Home sales, it's always good to have higher home sales. When we're having home sales, it means that people are looking forward to, they are capable of investing when buying in new homes. So this is also a good indication on the performance of the economy. Building permits, similar, and business inventories. Business inventories is unlike the others. Business inventories, it measures the inventory that we have at factories. So as long, or as at businesses. So when inventories rises, when inventories rise, they hint that there aren't much of a selling. So shops aren't buying much from businesses. So inventories are staying, and that they are. This means that the economy is not performing well. But as long as the businesses, they are just able to finish all their inventories, or get rid of all their inventories, or sell all their inventories, this is positive signal. Moving to employment, we start with the unemployment rate. On Friday, we have one of the key jobs reports. That's the US jobs report. So it is on Friday. You better watch out for volatility that could erupt from such a report. Unemployment rate, definitely we know what's unemployment rate. It measures how much unemployed there are in the market. Participation rate is the percentage of people that they are looking for a certain jobs. So as long as the participation rate is increasing, this means that more people are looking for jobs, and this could also be supportive for the economy. But some people, for example, following the collapse that happened in 2008, the participation rate fell sharply, since many people they thought that they don't want to look for a job again. So as long as people are just excited to go look for a job again, this will increase the participation rate definitely. Initial jobless claims, there are the claims that US citizens file every week as an insurance for being unemployed. Employment change is also a good indication. So always when we have positive employment change, it's good for the economy. And when we have negative employment change, it means that we are getting rid of certain openings or certain vacancies. So there are a lot of firings and laying offs. So this means that the economy is struggling. And also jobs opening in the United States. So as long as we have also higher jobs opening, it means that the economy is capable of creating more jobs. Non-farm payrolls gives us hint on the performance of the US labor market, how much people are being employed, how much the economy is being able to create businesses, especially outside the farming sector, which is a seasonal sector. The ADP non-farm employment change is just a private reading that could give us a hint on also the performance of the US labor market. And also along with the employment report, we get the average earnings index, which is also related to inflation. So this means this could allow us to know how much people are earning money, what's the average of the earnings. And this is as long as it goes up, it means that you are earning more money, you can spend more, so you can demand more. And when you demand more, the consumer price index will rise to healthy levels. So that's why before all this collapse happened, so the Federal Reserve was looking for the average earnings index, or average hourly earnings, and also the Bank of England was doing the same. since it affects inflation, and they were targeting back then healthy inflation levels. Moving to confidence. So when we talk economics, when you talk finance, it's all about confidence. If you lose confidence in a thing, you won't invest in it. If you lose the confidence in a certain, for example, company, you won't buy its product. So confidence is one of the key things, key elements for a successful or for a strong economy. So when you are confident about the economy, when you have confidence in the economy that it can perform well, you will invest in this economy. So you'll spend more money in this economy, and this money that you spend will go in the flow, and it will help a better economic activity. While when you are losing confidence about an economy, for example, this would definitely lead to shortage of money flow to this economy, and it will struggle more and more. So we have the consumer confidence reading. We have, for example, the CB consumer confidence, the Conference Board consumer confidence from the United States. Of the IFO business climate, definitely it gives us a hint about the performance of or the confidence in the US and the German economy. Also, we have the ZEW sentiment from it's a good reading for the German economy, business survey, and Centix investor confidence. So as long as these indicators are showing that there is more confidence, it is more supportive for the economy as a whole. We can see also good performance for the stocks. While if we see that investors, consumers, businesses, they are losing confidence, this could mean that we are going to struggle further. So this is for the top economic indicators. Now Sai will talk about central banks, the role of central banks, especially that central banks during the past couple of months, they had really good, they made really good job in trying to make the global economy recover, but still there's more to be done. So Sai will talk about these now. Sai?
Thanks, Wael. Hello to everyone. Hope everyone's doing good. Next, one of the important indicator, as Wael said, like central banks. Central banks are responsible for overseeing the monetary system for any nations, basically. The central banks have a range of responsibility when you say like a monetary policy to implementing the specific goals such as currency stability, and Wael was explaining about inflations, unemployment, So these are the main role where responsibility from the central banks. And central bank also in general issue currencies like functions of any bank governments, like a bank of governments, regulate the credit systems, or you can say oversee commercial banks, or mainly they manage the exchange reserves. So these are the major role for central banks. Moreover, central banks plays a crucial role in ensuring the economic as well as financial stability. That plays a major role over here. They conduct the monetary policy to achieve a low or stable inflations, and in case of any global crises, for example, we gone through the COVID-19 for the last few months. In this case, central banks have expanded the tool to deal with the risk on the financial stability, to manage the volatile of the exchange rates, protect them from the financial crisis. So when talking about the central banks, the major focus which have been set, as I said, like interest rates, macroeconomic targets, issuing the notes, like ensure the financial stabilities, inflation targets. That's the most important thing which have been seen in the few months coming across with the recent scenarios in the market situations. So these are the major things from the central banks, and the major focus and major response of the central banks. So this central bank, as you can see, there is three monetary policy tools to achieve the financial goals. So the three are their main, which is open market operations. We can say interest rates, reserve requirement ratio. We can say reserve ratio. So basically, these are the three which focus to to sustain or to protect from any type of financial situations. So when you go through one by one, so when you're talking about the open market operations, which is basically, we say that it's all the tool which is to reach to the target to rate by buying and selling the security in the open markets. So basically, the central bank is able to increase the money supply and lower the market interest rate by purchasing the securities. so which really create a lot of money flows basically. So similarly, like central banks can sell the securities from any of the amount from their balance, and it can be circulated, putting the positive pressure on the interest rate. So this is a major role of this open market operations, which normally we say OMO. By using the system, this is basically a system, which is by using the system, the open market purchasing, the central banks can produce a number of funds rates, which is providing to else to liquidity to the commercial bank. There are many banks under the central banks by selling or buying the government bonds within them. The major objective, we say in a simple like major objective of this open market operation, is to manipulate the short-term interest rates and supply the base money in an economy. So that's a major about talking about the open market. So it's an action of buying and selling the bonds on the market, open market, in order to regulate the supply of the money. So they keep out the supply of the money, they keep flow the money into the markets, and in a different sector, different categories, and different way of to implement the money flows to be kept on in a steady way. When a central banks buy bonds, they are increasing money supply, and they are selling bonds and they decrease the money supply. So this is what I explained to you. So asset purchase makes loans easier to obtain and write down rates. Selling assets, or you can say selling the bonds, or you can say selling the securities, or you can say anywhere as a selling the assets, makes loans more expensive and increase rates. So these are the one of the major tool for central banks to have a monetary tools to control the central banks from the central banks. So next is a very important one where interest rates. So when talking about the interest rates, many have gone through there are different major central banks are globally represented when I'm talking about from the top to bottom, like Federal Reserve Bank, European Central Banks, Bank of England, Swiss National Bank, Bank of Japan, Bank of Canada, Reserve Bank of New Zealand, Reserve Bank of Australia. So every the current status of the central bank rates, you can see from the Fed, like the Federal Reserve Bank stands at 0.25%. European Central Bank stands neutral, like the 0.0%. Bank of England with 0.10%, Swiss National Bank with 0.75%, Bank of Japan stands a negative of 0.10%, Bank of Canada is 0.25%, Reserve Bank of New Zealand 0.25%, and Reserve Bank of Australia stands at 0.25%. So these are the current interest rates for each central banks. So when you say the interest rates, what the major role for the interest rate for the major different rates? So the main mechanism of the central banks as to regulate the levels, its interest rates. Levels is interest rates. Basically, the interest rates are primary influence of the investment flows, any investment flows. For example, take for a Federal Reserve Bank, Central Bank of US, in that way. So if interest rates are very low, or what will happen, impact will be there, what could be the function will happen in the interest system, or if your interest rates are high, what investor impact will be there. So when your interest rates are very low, the reward of saving is relatively minimal, and it's cheaper to borrow money. That's what everyone knows about it. Basically, these interest rates are very low. Banks may feel that taking a risk in lowering lesser than the business in what, basically the particular scenes with the borrowing the money from the central bank at an extremely lower rate. That's what they feel like. There's a very lower rate, lower price you get to borrow the money. This could be also a lower interest for buying a home. So those who are a mortgage loan, they would like to go for a home loans, they find a very good price, because basically if you see all the central banks rates have been lower down for last more than a year. Even if you say for European Central Bank, they kept as a neutral at 0.0 as interest rates. They feel that the home buyers, the market buyers, feels a very comfortable price because the interests are very low. So when the interests are very low, this will be the impact, and this will be the more weight for a reason buying for new homes. When it coming to the interest rates are high, when the interests are being kept at a high level, investors will typically save money to earn interest on their money. Basically, banks give us a lot of interest, so the most of the depositors or investors go to the deposit to keep their money. So for borrowing money is expensive there. Basically, when they go for a loan or lending from the bank or any to have money, so it will more expensive because they have to pay more interest on it. So if interest rates are high, as a safer option, if it could be like keep the money and only the loan, those who keep paying back to the loan at higher interest. That's a major difference of it. But moreover, the high cost to the borrower may, like a business, from the business point of view, the same could be an individual looking for a buy a house. So this is all both the ways. So obviously, any central banks from any country look into their stability, so they keep changing. So that's really impact the markets in a high volatility. Like if any announcement comes about the rate change on their interest rate, definitely, and there'll be a big impact based on how exactly the change is going to happen, whether it's going to hike or going to reduce it. Based on that, this is going to be impact the markets on the interest rates. So here, like and talking about interest rates are one of the most important drivers of the financial markets. And central bank use interest rate to manage the economy. So as I said, like it's the most important thing. Interest rates can be raised to curb the inflations and lower the stimulate the economy. And also like higher interest rates usually result in appreciation of the currencies. That's what the general idea about the trader's mind, as well as the system works like that. Lower the interest rate usually result in depreciation of the currency. The appreciation and depreciation, when the higher it's get appreciated, when it's lower it get depreciated. But there are certain scenarios are there. Even sometimes markets moves in reversal way, but still it's has to be considered in a proper way how exactly the monetary policy works, and based on the monetary policy statement after the result, how this changes of the interest is going to impact the economic or the currencies in a future level of movement. So let's move on the next indicator, which is reserve requirement ratio. Like it's very common thing to understand here, because the reserve ratio is a portion of reversible like liabilities that any commercial banks must hold, rather than lending out for the investment. You know, this is a requirement like determined by any country's central bank. Normally they say the cash reserve. So any banks has a cash ratio or a cash reserve ratio, which normally mentioned based on how reserve to be kept on their bank. So this reserve requirement is type of a tool that a central bank has to dispose to the control the liquidity of any financial systems. Like for example, like of any monetary policy. This is like cutting out the liquidity and causing of cooling down the economy. That's the most important big, because they have to act very fast when they have enough reserve. For example, in many central bank have a different way of reserve. For example, gold reserve would be there, for bonds would be there. So different type of reserve system to be implemented here. So based on that, it is like work. So here the reserve requirements or the amount of cash that the banks must have to at the central banks. So banks must hold, even for this situation, for example, take for this COVID-19 situation, this plays a major role, because they have a stimulation package has been implemented, which each and every central bank to protect their financial crisis. For example, take for inflation rates or employment situations. So these have been a very important point at very worst situation in any economy. So central banks use this tool to increase or decrease the money supply. When reserve requirements are less, banks have more money to lend or vice versa. That's what I was saying. So these are three important level of monetary policy tool have been implemented by the central bank in case of any type of situations to stabilize their financial situation, as well as to stabilize their economic in that way. So that's a thing. So talking about the current scenario, as we are discussing a lot of things about the fundamental informations, indicators, how to impact. So the current situation of the markets, how to react, like what are the impact have been there, and what are the major news or what are the major matters to be influenced and to be flow in the market currently in the market is. One is the first is the COVID-19, the coronavirus developments. We've seen the like last almost half of the year, from the month of starting from January or February till now. Even there is a lot of second wave impact has been seen in many European countries or many other countries. So how this is impact? So these are the more important thing to be focused on any fundamental news informations about the developments, how exactly, and mainly we are all focusing on vaccine uh, COVID vaccine that is going to change the markets, or how it's going to be, how exactly it's going to impact the markets. Next to that, like always there is a trade tension between the China and the US. So this also makes a great impact, a great reaction, or maybe a lot of movement happens in the markets when there is any steps taken against US or China, or any type of trade information. So trade policy has been changed depending on the exports and imports. And coming to now US president elections, as well as you can talk about coming on November 2nd, and future of Brexit. So these are the major matters to be discussed when coming to the fundamentals. That's all about today. Thank you.
Yes. Yeah, so just to add a bit for what I was saying about the top matters to follow. So currently, following last week's resurgence of COVID-19, especially in the Euro region and in the United Kingdom, there were some thoughts that governments could go for another total lockdown, and this definitely stressed out the market. So we've seen DAX, Dow Jones, and indices were falling earlier last week and during the previous weeks. But when it was more clear that that governments will stick to certain measures and will try to avoid a full lockdown, this definitely had some impact on the market, and we saw indices recovering back higher. So this is the thin line that governments are trying to work on. They don't want it, they want to avoid the lockdown in order to keep the economic activity flowing, but also they don't want the spread to continue in their countries. So this is for COVID-19. Central banks, they are trying to do all what it needs to support the economic recovery. Still, and in August, we've seen some drawbacks in the economic indicators signaling that the economic recovery could be slowing down, which could urge some central banks to take some additional steps. And also, let's not forget governments that they are doing also some good job about fiscal stimulus, despite the recent allegation in the United States that that's happening between Democrats and Republicans. Now we're hearing some talks again about certain deal. So the Democrats a couple of days ago they tried to pump the deal for 2.4 trillion or 2.2 trillion, and yesterday Republicans or the House was almost close to 1.5, 1.6. So they will be able to find some common ground, but definitely also this could not happen maybe before the US presidential elections. And currently the Treasury Secretary Stephen Mnuchin, he was saying that if they won't be able to secure a fiscal stimulus bill before the elections, they will definitely work on one after the elections. The tensions between China and the United States, they're still there, but ahead of the elections, maybe Trump is just trying to play it a bit safe. He doesn't want to have more stuff on his plate. So maybe we could have some bit of a rest for this for a current while, but still every now and then we're hearing about possible problems or possible confrontation regarding tech companies. The US presidential elections also yesterday, we've seen the debate between Trump and Biden. It was more personal debate. It was so fierce, and both candidates they failed to have a clear like advantage and for voters. So we're still a long way to go for US presidential elections. And future of Brexit, currently yesterday, the talks were resumed. So they're trying to discuss a couple of stalled issues, but this could be a bit promising as we close to October 15. So this is about the top matters that you have to watch out for, in addition to these economic indicators and releases that could happen that happens on a cyclical note. So also these are the matters that you have to read more about, to have to do your analysis properly, to analyze what change in each of these matters could impact the market, how they could impact the market, so you can position yourself. On another note on how to trade using fundamental analysis. So I'm just going to demonstrate slowly on one of the tools that traders do use in order to trade in the market on the news. So I'm just gonna go over a chart fast and just like have a small presentation on how a trader can trade while the market is moving or awaiting some indicators. Okay, so for example, this is let's say we are waiting for a certain economic release. Let's go for gold, which had a really good move in the past couple a couple of minutes following the release of the GDP as GDP final reading. So let's take into consideration that we were waiting for a certain move. You know that there's an economic release that could have an impact on the market. So what a trader can go for example, they can go for settling a certain levels on the top and the bottom, and they can go set some buy stops or sell stops ahead of the release. So when the market goes up, if the release was good, they will catch a long position and continue to move higher, and vice versa. There are also other types. For example, if a trader is looking for a certain move, but also he's looking for a fade maybe for the move, so they will go for choosing some levels that they could be far away from the market, and they could be looking for certain corrections. So for example, like this one that happened today, the market rallied towards 1900, but 1900 is a good resistance, and then we saw gold dropping back again. Other traders, for example, let's say it was the other way around, so a trader would have started looking for some buy positions here. Definitely, if there was no change, like a significant change in the reading, and it's not changing or impacting maybe the decision of central banks on the long run, maybe the initial, most of the time the initial move, it gets faded. So this is a small strategy on how traders can trade on news. If you have any questions, please write them down. Okay, perfect. I believe this is it for today. Sai, do you have anything to add?
All good. Thank you, everyone.
Okay, thank you everyone for watching. Next week we're hopefully going to start with the introduction to technical analysis, and take the path forward by just adding to your knowledge in technical analysis. So this is all for now. Thank you all for joining.